G'day guys, it's Jake here. Nothing in this video is financial advice. Please do your own research when it comes to investing. Please be sure to check out my links below, including exchanges I use and social media content that I post. All right, let's go. So the topic for this video, we're going over the 18.6 year real estate cycle and how that affects the current environment, the stock market and the crypto market that we're in, and seeing where we are in this cycle to make the best decisions and take advantage of the current phase before it all comes crashing down. So I'll show you why. And it's very, very interesting, this cycle. It's playing out over 200 years, and I'll go through exactly the details of its formation. Okay, so here's an article discussing it from the 5th anniversary Anslyer, the bullion. Okay, so over the past 200 years, Western economies have recorded an economic cycle that averages 18.6 years. The shortest on record is 17 years, with the longest being at 21 years. Today, we explore this cycle and the impact on land, stocks, and gold prices, looking at where we currently sit to help forecast what comes next. The 18.6 year cycle plays out roughly 14 years of economic rising and 4 years of declining. The 14 years are divided up by a mid-cycle slowdown, which creates enough recession fears in most market participants to avoid most second leg altogether, usually only returning to the markets later in the cycle when assets are overvalued and overleveraged. These are the final few years up the up phase when most participants have returned to the markets and are fully invested. Is coined the winner's curse phase. It marks the final 2 years of the economy rising on average, which, following a secular bear market, takes hold for approximately 4 years, wiping out excess leverage from the system, along with most market participants, before starting all over again for the next 18.6 approximate years. So it just sort of goes over. It's not exactly 18.6 years. That's just an average between 17 and 21. Okay, over 200 years, that's pretty substantial. The history of these cycles playing out goes back to 1800. That's back as far recorded history, and I believe in the UK it goes back even further than that. All right, the United Kingdom. But yeah, it's 1800 to now. Right, it's playing out, and we can see on this chart, which I discussed, we have 7 years at the start of the phase. We have a mid-cycle slowdown, right, which can be a dip here or a dip there. It doesn't approximately, it's either or, okay. And so the years occurred, so 955, 975, 993, 2011 was the bottom of the markets and economic cycle, and then it rose up for 7 years approximately. And then we had a mid-cycle slowdown, which was a recession, okay, 61, 81, and 2001. They're all recessions. And yeah, this is another dip. It could occur a little bit later or approximately up to 7 years. It can be 10 years. It's in that rough range. It's not exact because it varies, okay? The cycle lengths from 17 or 21 years, like I mentioned, and it goes up from that mid-cycle slowdown for 7 years, and you get the very final phase, which is the winner's curse, 2 years. And then we had the blow off top, and then it crashes for approximately 4 years, as you can see there. And we had the cyclical peak and crash. So from 1972, 1989, 2007, there are all notable peaks in the market before crashes occurred. And then we had the bottoms around 75, 993, 2010. And yeah, there's some examples of some years that occurred when these cycles played out exactly. Okay. And we have public land sales to demonstrate this further, going back to 1800, as I mentioned, to 1923 though. So 120 odd years, first century or so. And you can see that the 1818, there was a peak in land sales, property sales, and it declined, which was recessionary, and that was the top of the cycle. And we had 18 years later. Okay, so 18 is the calculation of the average at the length of the cycle. Whoops. Apologies for that. 1836, we had a peak in land sales and declined. 1854, which was another 18 years, okay, exactly 18 years. And there was a peak and it declined. 1869 was actually not 18 years, this is 15 years, but it's very, it's very approximate because it goes slightly lower high there. The peak was very, it declined very slowly. So this wasn't quite 17 years or the minimum. It was 15 years. So it varies a bit. Then 1888 was 19 years later. So it was a bit longer this time around because this is a bit shorter. These two are shorter. This is slightly longer, right, to make up for that shortness in the cycle. So it was 19 years, nearly 20 years, and that peaked out and declined. And that was a sharp decline too in sales. That was more gradual decline. See that? Gradual. This was a sharp decline. Then 1908 was 20 years, okay, and that was a peak in land sales and it declined, right? And yeah, you've got three phases. Phase 1 is the first 7 years. Phase 2 is 7 years uptrend, and then phase 3 is a 4-year downtrend. So I mentioned that before. And so what's the dynamic between land stocks and US dollar and gold in this example across the three phases? So in phase 1, we find the US dollar gains strength against other currencies with the US economy leading the charge. So phase 1's the first 7 years, okay? And US dollar strengthening, leading the charge in the recovery phase. We therefore see the DXY move up in conjunction with the US stocks and land prices. Gold moves into a healthy accumulation phase after experiencing a sustained run-up phase in 2 and 3 of the previous cycle, okay? In phase 2, we find increasing liquidity in the system. See stocks and land continuing to move up, okay, the next 7 years after the mid-cycle slowdown. And higher price to earnings ratios in the stocks and increased debt on land. With liquidity flooding into the system, increasing supply of currency, we find the dollar losing value. The DXY settling into a downtrend and hard assets like gold gaining value, settling into a new secular uptrend. As we move into the final years of phase 2, the winner's curse phase, which I'll explain, we see the US dollar index fall off a cliff. We see stocks and land get over leveraged and overpriced, unsustainably so, and we see hard assets like gold and silver perform incredibly well. So we're seeing that now, seeing gold and silver doing extremely well and rallying. Okay, so this is the winner's curse phase, which I said I was going to discuss it, and I'll just spoil it for you now. But we are in the winner's curse phase, right in the end innings of this property cycle or economic cycle, 18-year cycle, and going into 2026 is where we see it peaking out. Okay, so we're seeing gold rally, seeing DXY falling, which is what it explains here. Okay, but we're not seeing land values fall just yet. Okay, land's still high, so it's just what we are waiting for to end the climax phase of this cycle. Okay, so in phase 3, all right, this is the climatic phase. We see systemic failures, banking collapses and resets, land and stock prices crash, going from being overpriced to underpriced. US dollar starts to recover after getting hammered in the previous phase. Hard assets like gold and silver continue to gain value as investors and central banks flood into precious metals to seek shelter from the storm. While some will avoid the sin and greed to avoid getting caught up in the collapse that follows, most will make decisions based on emotions and fall victim to a cycle that has been in play for centuries. Okay, while stocks and land prices rise in phase 2 and crash in phase 3, precious metals steadily increase in both phases 2 and 3, gaining value through both euphoria and the crash. Here's a chart to demonstrate the US dollar index compared to the rest of the currencies out there, and you can see, so in the early 80s, declined, okay, going into the late 80s, which was a recessionary period, and a decline going into that, and a bottoming out phase for recovery in the early 90s, which started the next property cycle, okay? We had a mid-cycle top in the early 2000s tech bubble, and obviously it crashed again, going into the next bust of the property cycle, which is 2007, 2008. So you can see that bottomed out approximately beginning of the recession, going into the end of the recession. And same as this one here, this big decline took from the mid-cycle to the financial crisis. And this one would have been the same, roughly. It was early 80s, okay, which is mid-cycle, and then crashed into the late 80s, right? And then we have here, we said bottoming out, okay, after the great financial crisis in 2012, and then we started rallying up, and 2019 or so, and going past that, which is mid-cycle, was around 2019, 2020, had that pandemic crash, okay, so that was the mid-cycle, and we actually went higher, so we did decline slightly, okay, around that period, then we did go higher, and now we're starting to decline, right, so it's slightly delayed, but is on track to decline pretty rapidly, pretty sharply, okay, going into this period here in the 2026 period to, roughly 2026 is where we see this bottoming out and potentially going a bit longer into 2029 and potentially 2030, as this chart suggests. So this 4-year down after the initial collapse of the stock market in 2026, it should go into 2029 or 30, roughly, okay? So we don't know exactly, but yeah, I'll show you on the next tab exactly roughly where we could land, okay? So where are we now? What comes next? This might be slightly outdated, but it's in 2024, which is good. And you can see, you go back to the most recent global financial crisis of 2009, most assets reached their peak around 2007. By the time it was coined a crisis of 2009, most assets had already found a bottom price. As a cycle has a minimum of 17 years and a maximum of 21 years, with an average of 18.6 years, is measured from peak to peak, we can expect this cycle to peak between 2024 and 2028. So 2026 is roughly estimations that most people are saying, with an average expectation of roughly mid-2025. Okay, so anywhere from mid-2025 to 2026 is where we're going to top out, all right? And this is the stock market, as you can see. And yeah, in the 07, that was a crash, of course. That was the end of the property cycle. And then the dot-com bubble was the mid-cycle. Okay, that was mid-cycle, and this was the actual end of the cycle. And we actually did go lower than this one. So it was a more severe crash at the end of this property cycle. And I've been rallying up since. This means we're currently in phase 2 of the cycle. Look out for the final phase of the uptrend, the winner's curse phase. Okay, we're in this phase at the moment. The final few years where the markets become over-leveraged, investors become overconfident before it all comes crashing down. Looking at the current market sentiment, we can see that most investors are barely confident, let alone overconfident, with recession fears still held by the mainstream consciousness. So while we are in phase 2 of the cycle, we are not in the winner's curse phase yet. However, we expect it to be around the corner. So what comes next? If history is any indication, a flood of liquidity and leverage is leading to a collapse. Okay. So there is another chart of the US dollar index, and expecting a decline going into the end of the decade, okay, as we find a bottom around there for the property cycle. The stock market can recover sooner, okay. Doesn't mean the stock market can bottom, in the end of this decade. It could bottom sooner than that. But this is the overall cycle, the 18-year cycle, okay. And you can see, the gold price is in pink. It continues to rise. And this previous cycle, even after the collapse of the dollar, gold continued to outperform, okay, on this collapse. And then eventually gold did tick down, right, shortly around the 2012 period, and it started to decline from there. And into accumulation phase before going up again, okay. And we're seeing it going parabolic here, and the dollar's starting to collapse. All right. So this is, yeah, the retracement level, 50% retracement from bottom to top. And it says here the 50% move up, which started in 2018, is around 101 level. This means any consecutive long-term closes below this level show objective weakness in the US dollar. Currently sitting around 101, which we are a bit lower than that. The XY could be in the verge of recording macro weakness, pushing us further along the phase 2 of this cycle as expected. While navigating stocks land and the US dollar will become chaotic, leading into euphoria and greed in the winter curses phase. And the collapse that follows, hard assets such as gold, silver will play a key role in providing steady, sustained growth and shelter from the chaos for individuals, organizations, and governments in the many years to come. That's the comparison. There wasn't many comparisons there. It's unfortunate, but you get the idea of explain how this sort of cycle plays out and the approximate length of it. And yeah, you'll see this will be important chart to watch coming forward, okay, and seeing a peak in land sales and like a big spike up like the previous times you see before its downtrend continues and then this decline kicks into full swing. So that is that one. This tab here is a bit more updated version because that was 2014. This is 2020, end of 2023, going to 2024, and you can see it's chart house prices and the time elapsed in the cycle. So the first half 7 years, second half is 7 years, and then the 4-year peak and collapse. And we have a mid-cycle slowdown in between at 2 7 years. Okay, the winner's curse, which you mentioned, is the very end of the cycle where we are currently, and we're just about to start it, pretty much right at the start of this big uptick. And yet 55, 75, 993 in 2011 was the bottom, and then we continued up until 61, 81, 2001, 2020. All right, so that's where we had this mid-cycle slowdown, and it was a bit delayed with 2020 because you can see that going from 2011 to 2020 is 9 years, so it's slightly longer than 7 years. Okay, it's 2 years longer, but it was a very short recession. It was a big drop, and then boom. The shortest recession, I think, in recorded history. So very short and sharp correction and bang, straight back up. So this would have played out sooner, like 2018, 7 years after 2011, or 2019, but it happened a year later, and it was quick and short and sharp, and then took off again. So yeah, there was a decline in late 2018, okay, in the stock markets, crypto markets as well. So that was a correction, and then we had another correction, obviously, into the pandemic. And then we continued up into the right. And yeah, we'll see is 1982 as a top, 1989 was a top, 2007 was a top, and prediction to 2025 to 2026, somewhere in that realm. And major recession will occur after this period, and then it should go into 2029 to 2030. All right, this is for real estate, and the stock market bottom sooner than that. Okay, the stock market usually leads a recovery, and yeah, it doesn't always lead to declines, but it leads the recovery after the crash has occurred. So the stock markets will pretty much bottom first and continue to rise before the land will catch up, house prices will catch up, and then yeah, we're back into full swing into the next cycle. But that's coming up ahead into the end of the decade. So the years of expansion, and then 2010 to 1983, 1975 were the prior cycle bottoms of the property cycle, and that is that. And here's Bitcoin, okay, and its trajectory, okay, it's logarithmic regression curve over its history, going back to 2009, October. Actually goes back further than that, but this is the chart that we've got, okay, and it's followed this logarithmic curve pretty well, as you can see there. You know, from the inception, it didn't really follow it, but as soon as it established itself, and see the volatility here, you can see there's gaps and there's big candles, wicks, and it was messy because it wasn't really established, and then it started to get more liquidity and started to grow as an asset, and then eventually went to the top of this band, okay, in 2011. And it came back down, got close to the bottom, and then trended up. We had top here in 2013, decline to the bottom, 2015. Okay, didn't go below it, and continued up into 2017. December, hit the top, declined, didn't hit the bottom of the band. We came back up, mid-cycle top, 2019, declined to 2020, and we touched it. Didn't close a candle below the zero bound level. Got the 100 and the zero bound, and this table just represents the prices at where we're at the points of the bands. And 2021 peak didn't go to the top. It got close, but didn't touch it. It's not perfect. Okay, it's just a guide, and it went down and touched the bottom, and we had to push up from that low in 2022, and now we're currently sitting at 42 risk, which is the mid level of these bands, roughly. The 50s obviously mid level, and we're sitting at 65, so just above this 40 level on this risk metric. And in terms of cycles go, so I did mention this was 2009. This pretty much started right after the bottoming out of the stock market. It's 2010, you can see there, 2011, right? Then that was when the property market started to pick back up again. It bottomed out, it started to pick up, and crypto was an emerging asset. Bitcoin itself was, and had its first major rise, potentially, before declining. It's very volatile in the form of cycles, okay? So it did have a decline. In the broader macro, it was still bullish, the long-term trajectory of the cycle, and continuing to rise after the halving in 2012, continuing to rise at early peak 2013, and it declined, and then it went back up and peaked out in 2013, and then declined after that. The property cycle was just continuing to move higher, still in the first phase, 7 years, okay, and it declined, and then it bottomed out around these zero level bands, and then it continued to pick up, okay, and it has massive run in 2017, and topped here, and this is 6 years into it, okay, and then decline. We're in 2018 now, or 2019, pretty much after its big bear market, and then we had a rise up mid-cycle, and then that decline there, right? This decline, you'd argue was a mid-cycle, okay. This is like a mid-cycle point in the property cycle, okay. So this is the midpoint in this after 7 years, from 2011 to 2018 was roughly 7 years. So this is the mid-cycle. You also see the pandemic crash here. So it's either that section, right, or this section here. So it's not approximate. It's just average. It's just roughly between these periods. So 2019 it got into 2020. Okay, so that was the crypto market. All right, Bitcoin, and that was very short-lived from March, and boom. By May, we're already out of this trough and back to the races again. So the mid-cycle had occurred, and the next 7 years, okay, from pretty well 2019, if you want to take an average between 2018, 2020, 2019 roughly, and 2021 had a peak there, slightly higher than this one, and we declined. It's another bear market in the form of this cycle, and we're continuing from this bottom, and we're continuing to trending higher. But we are roughly 5 years into it, okay? Roughly 5. If you want to take 2019 average, we are 5 years into it, and we've got another couple of years to go. All right, 2026 is, roughly where we can top out at. 2018, 2019, so roughly five and a bit years. And we're so close to peaking out in late 2025 or going to 2026, okay, as this continues to grind. We could see a decline in Bitcoin's price before going higher, called correction, and anything's possible. All right, get to these levels or go higher, going into the mania phase. You know what I mean? Like anything could happen, or it can just break the highs, right, and then just continue higher. Anything's possible. We have recession fears at the moment. I've mentioned in previous videos, so just be on the lookout for that. If we do get a little recession, a little tiny little miniature recession, could interrupt the cycle slightly and then continue after the Fed intervene and QE begins, and then money printing, and then boom, the cycle the mania phase can continue into 2026. So yeah, that is Bitcoin represented property cycle. Now the S&P as well. Okay, and we'll go back. I don't know how far you want to go back, but you can go back to the 70s, okay, roughly. So 1968, 1969, so basically top around that period. And bam, it declined, right? And that was before, or roughly right around on the property cycle, topped a bit later, okay, and did decline. And they had a big bear market from 68 down to 970. And I think it was 73. So we had a decline there, 970. Another rise back up, 973, and then decline 1974, 5. So I believe if I go back to this, you can see here at the bottom was 75. So it would have been roughly 71. The housing market would have peaked out roughly early 70s. As you can see, 1972 here, going into 75, right? So that is that. And we did peak around 73. It's a bit later for the stock market, and then it crashed shortly after that. And bam, going to January 1975. Okay, and then it continued up after that. Right. If you go back to the other one, you can see that 75 was the start of the next. Sorry, here 75 was the start of the next real estate cycle. Okay, so we continue higher, higher, and higher, and higher. You have a correction here, and continue. Had a top here in December 1980, and we declined a fair bit. Okay, so we had a recession here in 1980, and then 1981 to 1982, we had a big recession here. It's a bit longer than this one, as you can see, and stock market decline. If we go back to 1981, okay, it started the top to the bottom in 1982. Go back to this. It says here on the mid-cycle slowdown that occurred in 1981. So that is correct. Mid-cycle slowdown. We had that on the stock market chart here. Okay, so you declined here, and that took off after that. And the market just went off a big tear after that. Just on a march, man. And it continued. And then 87, we had a collapse, which was short-lived. And then the market just recovered really quickly after that. And then you can see 81, and then going up to 89, 1990. The peak in the real estate market was around 89. The stock market went for a bit longer, 1990, before it dropped, okay? You see recession here occurred. The collapse wasn't very severe. It was pretty mild. It was 20%, so it wasn't a big, bad recession at the end of this property cycle. But nevertheless, it was a decline, okay? And that was 1990 topped. If you go back to the real estate cycle, it was at 989, as you see here, okay? And that lasted until 993, as you can see here, all right? 93, go back, and then the stock markets recovered pretty quickly, so it led the economic recovery, okay? And then the real estate market bottomed 993-ish, okay? It's a bit later. So the property market did bottom a bit later, but it caught up to the stock market, and they both started its new cycle, okay? And obviously it's continued on a tear, and this was the mid-cycle, so up to the first 7 years, and 2000, 2001, so we had a top in late 2000, and it declined into the recession of 2001, and obviously declined for a fair bit of time. This is a bad mid-cycle. This is terrible. So August 2000 to September, basically roughly 2 years or so later, it just declined really rapidly and bad. Okay. And that was around 2000, 2001, which if you go back to the chart here, 2001 was mid-cycle. Okay. And then we bottomed shortly after 2003, and we continued up into the 2007, 2008 top, as you can see there, and declined into 2008, 2009, and the stock market bottomed around March 2009 and continued on a tear. All right, after that, if you go back to the chart here, it was 2007. All right, so it did top around the same time as the stock market did. Probably shortly before, I think the housing market did top like 2006 or so, and started declining. The stock market topped at late 2007 and declined. All right, and then that bottomed out. The housing market did in 2010 or so, 2011. As you see here, it's a rough range. The stock market's bottomed in 2009. All right, 2009, but the property market bottomed around here. Okay, after another sharp correction, and then they're on a new charge, and you can see 2019, 18, the first 7 years. Okay, 2011 to 2018 did have a decline. Okay, so we had a decline here, and that was 20%. So nice decline in the stock market. Okay, and they had another decline here, which is a proper recession, which was the pandemic. Okay, and that was quite a bigger drop. That was 35% drop, which is a massive decline. Look how sharp that is. But the recovery was just as sharp. Okay, so it's nice and good. So we had 2 mid-cycle declines. Okay, if you go back to this, so yeah, it says 2 here. So it can be 2 or 1. Okay, so we had 2 roughly. So 2018, 2019, and 2020. Roughly, it's not exact. It's just a rough schematic. Okay, and it says 2 in 2020 here, which is what I showed you. So this is where we are in that scenario. Okay, and then we played out, of course, and then shot up. And we had a peak here in 2021 and then decline in 2022. Okay, right. That was the Fed fighting inflation. And then shortly after that, it was January to October, so it wasn't even a year. And then markets just went on a rip. And where are we now? We're up here. Okay, we're at all-time highs, sitting pretty sharp and strong. Okay, as you can see there, going into October of this year. And we are still a couple of years away from the peak, all right, into 2026, okay? Still got some fair way to go, right? But you can see how I showed you how it all played out throughout history, going back, I just went back to the 70s, all right, to 1970, and then 1975, all right? But yeah, it was interesting how, some top at the same time and sometimes it doesn't, okay? It's roughly, as I mentioned, and yeah, it's where we are tracking for the markets right now. So I hope you enjoyed this video, just going over the 18.6-year property cycle or economic cycle, if you want to call it that, or the land cycle. There's different names for it, but it coincides with, the majority of the wealth, which is tied up in property. Okay, it's one of the biggest asset classes. Besides, stock markets, you got bond markets, you got crypto now, and yeah, there's a lot of different assets, but the property market is the most important land market. And when that starts to slow down, which it isn't at the moment, it is still continuously rising. And when that starts to decline, the sales do, it means that the collapse is about to start, okay? And this is the end of the property cycle. But fortunately, we've still got a couple of years to go, okay, before the end of this property cycle. And I mentioned on the slides, going back to the first article I mentioned, and it talks about gold as well. So commodities are incorporated in this cycle as well. They have a bit longer cycles. They have 25-year cycles, I believe. So commodities have a bit longer cycles. They have big, long accumulation phases in between. So periods of nothingness, but they have big, long expansion phases, okay? And it can exceed the crises and continue higher even after the collapse has begun. So commodities don't rise and fall the same with the stock market. It's a bit different, okay? But they all coincide with each other. And yeah, I did show you that in the first article there. The second one just shows you where we are, how we have been. And we have 7 years of the first phase and a decline in the middle, mid-cycle slowdown, and then 7 years up, and then a 4-year decline. Okay, and this is the average, going anywhere from minimum of 17 years to the maximum of 21 years. Okay, so that is that. And I showed you some charts of Bitcoin where it fits in with this property cycle and the stock market, the S&P, going back to the 1970 period to now, showing how it played out pretty well. I can go back even further. I can go back to 1800s if I wanted to, but I don't have time. He's got to bore you to tears, but he's got to trust the data and stuff I just showed you on the slides. And hopefully you got a good grasp of information from this. And if you want to see more information, comment below. I can definitely go into more detail because it's a fascinating topic. Okay, so yeah, if you enjoyed this introduction and analysis into this property cycle topic that I haven't mentioned before, but it's Very, very fascinating. Please smash the like. I want you to comment your thoughts below. Subscribe to stay updated. Be sure to check out my links below, and I'll catch you in the next one. Cheers.